All right, welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and today I got a couple exciting things to go over with you. We're going to talk a little bit about the market. We're going to talk about some changes that FHA has recently made and how that is going to impact mainly first-time home buyers, but we're going to go through some of these stats really quick, so buckle up and here we go on a little ride. First of all, I want to talk about the market. I did a market update, and I do these on occasion. This episode is not going to be a full market update, but I just want to say it's really choppy out there. You know, we're getting mixed information every time we turn around, and it makes it really difficult to predict what's going to happen with interest rates. You know, for a while, they seemed like they were really improving, and now they've turned up. I'm going to go over that in just a second here with a little bit more detail. But even, you know, the core CPI came out on Valentine's Day, and it was better year over year, but, you know, worse than expectations. And then we saw jobless claims were lower than expectations. And so just, you know, continuing to see strong employment data. It'll be very interesting to see what revisions are made in February after that huge jobs report last month. So, you know, but just a lot of volatility. And as I mentioned in a previous episode, you know, we're expecting March to maybe be a month where, you know, we had pretty low inflation numbers in March of 2022. So in order for us to even come in lower than that, you know, we'll have to see what happens. So bottom line is I expect some volatility. And the impact right now to interest rates has been they've been creeping back up a little bit. But the difference right now is we're heading into that spring buying season, and we're moving quickly. I've joked about my favorite holiday, as you guys know, President's Day. We just had that here on Monday. And so we're beyond that, and we're into that season where Super Bowl's over, and we typically see things start heating up, but now we're faced with a little bit higher interest rates. It'll be interesting to see how that plays out. But I'll tell you this, lots of people getting pre-approved, lots of people out there shopping, and not a lot of inventory. So as we expected, it's going to be an interesting home buying season. More to come on what happens there, but let's talk about interest rates a little bit, because I was going over this graph earlier today and I thought I'd share some of these statistics with you guys. And this is just not a rate quote on any specific type of loan product or program. This is just kind of giving you in general where mortgage interest rates were, and this is per Optimal Blue, which is a pricing engine that's going to give us an average of what interest rates were on any given product, right? So not a specific product, but I'm going to look here for this example on what the average rates were on 30-year fixed conventional rate loans, because that's what most people are getting right now in the market. And what we see is that current rates for 30-year fixed rates average around 6.64. Now, the peak on this in the last 52 weeks, and you can see the graph up here on the screen, we peaked at a rate of about 7.16. So we're definitely about 52 basis points lower than the peak, but we're also up about 250 basis points, 2.5 points from where we were about a year ago, but we're up about 43 in just the last month and about 20 over the last week. And so you can see that on the graph, but it just kind of shows you we've definitely been in an upward trend from where we bottomed out here the first part of the year. And it's going to be interesting to see how that impacts mortgage applications. Like I said, with rates kind of going up and putting pressure, we typically see less applications. But then we have the home buying season, coming upon us. So it'll be interesting to see what wins out here. Does demand for housing and this pent-up demand kind of, push through despite the little bit higher interest rates? I think a lot of people are getting used to the idea of using temporary buy downs, or even just the idea of, hey, let's get into the home that we really want right now while we can, and we'll restructure our financing at some point in the future if and when those possibilities present themselves. So I think that's what we see a lot of people doing, but I just thought it was interesting to note what's actually going on with rates, and we can feel the pressure, and borrowers are getting a little bit higher interest rate today than what they thought, because things are moving rather quickly. Now, let me throw back up this graph again really quick, because The other thing I want to note is you look at the low in February of 22 over here at the beginning of this graph, and what you see is, it peaked around probably around December of 2022, somewhere in there. But as you notice, this wasn't a straight line, and markets never move in a straight line. There was a few times where it dipped along the way, and we can kind of expect the same thing on the way down. So what we might be seeing right now is just one of those spikes. And we're going to see it come back down as the overall trend over time we know is going to be for lower interest rates eventually. So this could be a blip in the radar. I do tend to think as we get through March and as we get towards April and May, we are going to see inflation numbers really start looking better. We're going to see the shelter component of inflation finally catch up and start looking better. We're already seeing certain things have over supply and inventory. We are hearing more and more about job losses in the tech sector. I just read an article today about Facebook and potential layoffs there and what are Meta, as I guess they are. So anyways, this could just be a blip. And, Barry Habib, if you watch him or a lot of economists, but Barry has a great analogy, which is, whether the market's going up or going down, it's like an escalator. And it's kind of like a kid on an escalator with a yo-yo. The overall trend is going to be for lower rates, but that yo-yo is going to go up and down on the way, and we could just be at the top of the yo-yo right now, and maybe we see that turn around. But again, these things are happening live and in real time, so we will keep you up to date here on Market Shares on what's going on there. So hopefully that was helpful and insightful information. Also, big news this week from HUD and FHA. Finally, we get some relief on the FHA MIP premium. So the MIP premium for most borrowers has been at 0.85% annually for a very long time. I don't even remember when it changed to 0.85, but it's been there for many, many years. And we recently saw them revise this down to 0.55. So your annual premium, instead of being 0.85 of your loan amount divided by the next 12 months of payments, now it's going to be 0.55. So 30 basis points lower. And that's very welcome news. It's been anticipated, but I'll tell you personally, I'm kind of bummed that they didn't also get rid of the life of loan component of the FHA mortgage insurance premium. As you guys may or may not know, on a conventional loan, once your principal balance reaches 78% loan to value, it's required to drop off. And after the Great Recession, and they revised MI premiums for FHA, they also increased this to a life of loan. So you pay mortgage insurance and you pay it for the remainder of your loan unless you refinance out of that FHA loan. Doesn't mean it's a bad loan option. For many, many people, it's a great option. It just is something that I would like to see go away, because I think it would put FHA a little bit more in line with what we see on conventional financing. But this is really a big step, you guys. Of all first-time home buyers that take out mortgages, so of first-time home buyers, about 80 to 85% of them utilize FHA financing for their home loan. So this is going to help a lot of people have a lower payment. And I did a quick example for you guys. Having a lower MI premium that's 30 basis points lower, and let's say this was on a $400,000 loan, that's equivalent to about a 3/8 lower interest rate. So it would be like interest rates dropping from 6 7/8 or 6.875 down to 6.5, or from 6.5 down to 6 1/8. So it's pretty substantial. I'm sure the numbers vary a little bit depending on the actual note rate, but just to give you a ballpark in order to visualize this, this is like having a pretty significant improvement in interest rates, because it all impacts your monthly payment. So if we can see a little turnaround here with mortgage-backed securities and get inflation under control and get rates to come back down, you couple that with this reduction in MI premium, and I think we are set up for a spring buying season where we could see some significant relief over the coming months for our first-time home buyers. Here's another stat for you guys. Of loans that are 95% loan to value or higher, so anyone putting less than 5% down with a 680 credit score or less, which, look, a lot of people come out of their younger years with some dings on their credit, for whatever reason, especially going through what we went through over the last couple of years with COVID and so on and so forth. If you didn't have a lot of savings and you worked in the service industry or whatever, for an example, chances are you may have had some tough times making ends meet, missed a couple credit card payments, whatever. That's going to put your credit score down under 680. But as a statistic here of first-time home buyers with 5% down or less and a 680 credit score or less, 75% of those individuals utilize the FHA loan to obtain their financing, and only 25% use other means of securing their home financing. So that's pretty significant, and there's a lot of young first-time home buyers that I think fit into that category of less than 5% down and less than perfect credit. Now, look, FHA is a great loan program. It is not intended to purchase investment properties. It's not even intended for someone who has a large amount of down payment. Doesn't mean you can't use it, but the program is really geared towards low to middle income borrowers. And I think that this change by HUD really helps them be able to serve the markets that this program is intended for. So I welcome this change to the FHA program. I think it's going to help a lot of people, and I think it couldn't come at a better time. I hope that at some point in the future they do revisit the life of loan aspect of the mortgage insurance, because it does require a lot of people to refinance out of their loan at some point in the future. That's great for those of us in the mortgage industry, but it forces an extra step in many people's case, because as they build equity, even if rates aren't significantly lower, they're like, why am I continuing to pay this mortgage insurance premium? And they tend to seek out options of refinancing to get rid of it. And it feels like once they reach a certain loan to value, the risk to HUD of having to guarantee that loan or insure that loan to default should go down over time. So hopefully we see that at some point in the future. I think that would really give people that are utilizing the FHA program some relief. But until then, we will take the 30 basis points improvement to the mortgage insurance premium, and let's just see, you guys, over the coming weeks what happens with inflation and interest rates. It's my hope that we've hit another peak and that we start to see some relief as we really see this spring home buying season heat up. So that's what I got for you guys today. I appreciate you taking the time to watch Market Shares. I'm going to keep coming at you with what's going on with the market, because these things are changing on the daily, and I want you to have a place where you can count on for up-to-date changes that are going on in the market. And then I have some other really great ideas on some tactical stuff that loan officers, realtors, and branch managers can use to just be better at your job and be more efficient. So look for those episodes to come in the near future. And if you haven't already, please like and subscribe to Market Shares. But more than that, tell your friends about it. Get other people in the industry connected to this information, and I would sure appreciate those referrals. And until next time, take care.